Okay, we're going to get started. Happy 4th of July to everyone who celebrates. And we're going to start today by looking at the S&P 500. You can see that we're super overextended right now. We're above all moving averages, and we have momentum in the stock market. According to the S&P short range oscillator, this is an oscillator that it's a way to measure the overbought and oversold nature of the stock market. We are we were super oversold during the sell-off in April, and that was at -8. And whenever right now we're overbought, an extreme overbought by 7.38%. Okay, so in general, whenever the stock market is overbought, it's time to take some off the table and to sell some or don't buy at all. Whenever we're way oversold, such as in April, at a -8, then that's the time to buy or don't sell. So there's basically people that follow this, and um, you have to be a contrarian in general when establishing new positions, or if you have tactical trades, this is the time to start selling or don't buy. Okay, so we are in an extreme right now. As I mentioned, um, basically all year, the week of July 4th is usually a really good week for the holiday, I mean, for the stock market. We've gotten to a point where it rallied basically 1.5% this week. Um, and we have an upcoming tariff issue on the 9th of July. So on the 9th, the president will decide on tariffs. And we delayed that 90 days from April. That made the stock market rally a lot. But right now, we're at a point in Wednesday where we could have all those tariffs go back on and have the stock market go into chaos. Because of that, I'm concentrating on some conservative investments this week because when the stock market is nuts and going crazy and going down and or unstable, people might gravitate towards stocks that have a high yield, that are consistent earning companies. Uh, Stocks that come to mind are maybe tobacco companies, companies in the utility sector, with steady demand and high dividends. So we're going to look at some of those this week. Um, and just keep in mind, don't get over your skis. Even though it looks really good in the stock market, like right now, we're like super overbought. There is, whenever we're at a super extended level, don't be surprised if we correct some. All right. So, okay. So July is typically a good month. We know from our monthly stock market returns, July is a good one. But we're going from July into August, September, which are not so great months. Also, I added this VIX composite by trading day of the year. You can see June, July, we have very low VIX ratings, meaning it's very calm in June, July, because it's nice weather out and people are feeling better, maybe. I don't know. Um, but as you can see, August, September, the VIX starts going up and the volatility picks up. So we do expect some trying times in the coming months. So get ready for that. And towards the end of the year, we usually expect a end of year rally. Seasonality, this doesn't always work, but it's been working for us so far. Okay, so let's look at some of our talking points. We have earnings coming up. So in July, we have the bank earnings. the Citibank, JP Morgan, Bank of America, they all come out 2 weeks from now. Not this week, but next week. And then we have tech earnings starting to come out again. And that's going to basically dictate, where the stock market goes. We have Apple coming out in August, and then NVIDIA is the last one, major tech report in August. Then we have the Fed meeting again in the middle of September. So all of this combined, um, we have a lack of earnings reports after around right here, and that's going to, and we have a kind of a negative 2 months in August, September. Um, let's look at some more things. Okay. All right. So let's look at our numbers here. The 10-year yield is down 0.5% since last week, and the 2 years down a little bit. We have what do we have? We have a lot of momentum in the stock market. 70% of the S&P is above the 50-day moving average. That is a huge sign of momentum. And 61% are above the 200-day moving average. Okay, so we do have momentum in the stock market. All this momentum might be squashed by tariffs because tariffs, in the worst case scenario, makes the earnings of the vast majority of S&P 500 companies unknown or questionable, right? So the biggest things we're concerned about in the stock market right now, tariffs, um, possible geopolitical events. Tariffs are one remaining things that could cause the stock market to correct or not go up anymore or go sideways. And okay, so right now, let's look at the stochastics of the S&P 500. You can see we're in an uptrend here, and we're making higher lows, higher highs, but we're overbought. So, um, so we went up 1.5% this week, and we're super overbought. We're in an uptrend. Um, we'll see what happens, but right now we're super overbought. It's not the time to establish new positions. All right, and you can see we're still in an uptrend in a 5-year chart from the pandemic. The U.S. Treasury, it's very interesting. Um, we had the Treasury yield go up a little bit in the last half a week, but the stock market kept going up. We had this this divergence where the S&P was going up as the yield of the 10-year goes down. But we have to keep in mind the current yield of the 10-year, which is, let's look, 4.34%. Okay. Okay, so you can see it's kind of going down. It's in a sideways pattern. So if you can see, this is the low end of the range, and this is kind of the high end of the range. So we're not really going anywhere in the 10-year right now. That's good for the stock market. The stock market, if this starts going higher and goes above 5% again, then the stocks might have a problem of going up further. But right now, everything is under control, it seems. Okay, let's look at other variables in the stock market. The price of oil went up just a little bit this week to $66 a barrel. We just had an announcement. OPEC members agreed to a larger than expected oil production hike. That means there's more supply on the market, meaning the price of oil should go down. So um, this will probably be down to 60 next week or something like that, seeing that there isn't any more geopolitical issues. Um, we have inflation. It's still remaining around 2.4%. Tariffs that are going to be announced in the next week, that could drastically change the inflation outlook. That's basically the one reason, tariffs are the one reason why the Fed has not reduced interest rates. We have gold, it is down 3%. Um, and I guess what the reason I can think of is the stock market's been rallying, and gold is a risk off investment. Whenever there's unknowns in the stock market, such as tariffs, gold underperforms. I mean, it performs better because it's a investment that's s- stable and consistent and reliable. So we might see the price of gold go up in the next week as tariffs are announced. We don't know. All right, and let's look at the US dollar index. It's continuing to go down, 97, 96.99 this week. So it's down 0.5%. So it continues to go down. This is, I'm not sure the ramifications of this, but it's helping the US multinational companies. Anyone who sells overseas is going to realize better profits. The big tech stocks are going to be helped by this. Um, and the international markets will be helped by the lower dollar. So you can see there's a lot of international markets this year that are going up a lot. So for instance, European funds, a lot of the Europe countries are up 10, 20% this year. And it's helped by this US dollar. So when the US dollar goes down, our formula will help emerging markets, companies like Mag 7 doing over 50% of their business overseas, and it usually helps commodity prices go up. Um, right now, there doesn't seem to be a correlation to commodity prices and the dollar. All right, so let's look at the fear and greed index. We've gone to extreme greed, where our translation, cautious, take some profits off the table or don't buy. So don't get don't get over your skis right now in stocks or investing excitement because there's a very good chance that um, we could take a break. Okay. Um, all right. So we have a AAII sentiment survey, the American Association of Individual Investors. Most of them are bullish now, and that is a contrary indicator. You have to take some profits off the table. So when the amateur investor is buying, the professional seller is selling to them, and that's called feeding the ducks. All right. So now we have a VIX that's really low. It's at 16, it's 17 this week. And this is the time when professionals start buying protection because it's inexpensive and it is no one in the market right now seems to be fearful. All right, so let's look at our emotional graph. Right now, the market is extreme um, greed. So we're thinking there's a new paradigm with maybe AI. We have um, no tariffs to worry about, but just when we're at the top, the amateur investor is surprised by lower prices. So maybe in the next week or two, we get some lower prices and we get fear into the market, um, capitulation. And this is the spare time is when you want to buy. And this is the time you want to sell or don't buy. Okay. In our, let's see. Okay, just a reminder that we are overbought in the stock market. Our PE ratio in the S&P is 24. And that doesn't usually last very long. Right now, it's we have a lot of um, momentum in the stock market, and there's a lot of good feelings. We have a PE of 24, and traditionally, um, the PE ratio for the S&P is around 17 to 19. So that's a lot lower than it is now, maybe 20% lower. So if we return to the norm, that's a 20% lower than where we're at right now. So as an investor, you have to understand that risk of returning to the norm, and you have to be ready for market volatility. All right, so let's look at our first to worst. you can see the best performing sectors this year are industrials, financials, and communication services. All right, and we have materials doing really good too. So the worst performing sectors, healthcare and consumer discretionary. So healthcare has underperformed for 3 or 4 years in a row. Not sure how long that's going to go on. Um, Consumer discretionary, perhaps uncertainty in the market, and um, earlier in the year caused people not to buy things that they didn't need and wanted. So, look, let's see how this progresses throughout the year. If we have volatility going forward, utilities are going to help because they're stable and they have a little bit of AI um, growth interest there. Um, all right, so let's look at the sectors going up and down today. First of all, let's look at the 10-year. It's been going down. So as the 10-year goes down, we should have our cheat sheet is 10-year going down. That's positive for small caps, high yielding stocks, home builders, speculative, and REITs. It's negative for large cap tech stocks. Okay, so um, we have a rally this week in the S&P. So I think that's taking over our formula for interest rates. Interest rates aren't a concern whenever stock market is going up and rallying. So, but let's look at the top sectors going up and down. We have tech funds. Okay, we have regional banking, financials. Okay, this is basically a risk-on trade in general. Um, Risk-on means people are buying and excited about the holiday. And we've been talking about that for like a year now. Uh, so, um, so today that kind of trumped everything else in interest rates. The things going down the most, home builders, we have we have materials, consumer staples. These are risk off. So the no one's concerned about dividends right now, and they're mostly concerned about getting in on this rally. That's kind of the translation. All right, so let's look at the top stock movers going up and down. We have a lot of solar stocks, Enphase Energy, First Solar. Um, the reason those are up a lot is the bill that was just passed by the president um, had had a lot of good things for that industry. And so some of this is politically oriented. And okay, we have cybersecurity is another um, beneficiary of the top market movers. Um, the ones moving down the most are home builder stocks, and all top five are home builders. We have Merck. We have a lot of these are risk off. So Merck pays a dividend. It's very conservative. You have um, home builders. I'm not sure why they're down because interest rates are going down. They should be going up. And Brown Forman, they sell, I think they sell spirits and liquor and alcohol. Um, okay, so that was a good little exercise. Let's look at Dan Niles picks from the beginning of the year. You can see that his Cisco pick is up 16%. That is pretty amazing. Um, it's a very conservative stock compared to the other tech stocks. It's an older stock, and KBWB is what I meant. They're a banking ETF. So I thought it'd be interesting to I think, well, these are the big banks. All the banks' financials are doing really good this year. and they're going to benefit as there is deregulation by the new administration. And there's a ADTN is doing good. And so Dan Niles gave an update on ADTN. He says, let me see, for my top 5 picks, I tried, he sent this week. I tried to pick 5 names that hopefully investors that do not have the time can set it and forget it the whole year. Having said that, sometimes there are disasters, such as his Facebook pick. And okay, so he's updating his picks from this year. On average, it should be better than the market return. So far, ADTN has been disappointing with their execution on many factors. I thought it was my riskiest stock pick with the highest reward. That means the case today. So he really thinks it's a high risk, high reward. They don't have like a good earnings profile. Cisco and ADTN were my only 2 stock picks enter the year. And yeah, so these are the 2 stock picks. Every other one is, this is a mid cap ETF and this one's a banking ETF. So ADTN, there was a surprise CFO switch a couple weeks after their quarter report. Um, so there are some unsurprised things that happened with the company. I'm thinking whether to remove ADTN. So that's an iffy stock. I think we said at the beginning there this was the most iffy stock of all of them because they're a smaller stock and they don't have a whole lot of earnings. AI ADTN stock, despite all these missteps, is still up 8%. They're down through down 24 at its closing high. My conviction is certainly lower due to this missteps, but not gone. Okay, so we'll not. He's losing conviction on this pick, so we'll like we're not as excited about that anymore. And as he updates these other ones, I'll post his comments. So let me see. Okay, here's some interesting charts. The XLI industrial sector ETF. It's it's overbought right now, and you can see what I thought would be interesting is to go into this best performing sector this year, and see some of the elements of this ETF. We have GE Aerospace, RTX, and these both have benefited by the wars that are happening now, and um, what other things? I'm not sure why these would possible defense spending by foreign countries. So Europe is like Germany, they had a big initiative for um, defense, and perhaps there's some more of the European nations that are going to be adding to their NATO defense spending. So we have Uber, that's up a lot this year. Caterpillar, Boeing, Honeywell, Union Pacific, Eaton. Okay, Eaton and GE Veranova are 2 companies that are benefiting from the build out of AI infrastructure. So a good number of these companies, no, so let's say two of these are benefiting from AI build out. And let's look at some of the other ones here. ADT, Train Technologies, Lockheed Martin. Okay, Lockheed Martin's another defense company. We have 3M. Most of these are conglomerate. Emerson is also an AI build out. They help build the infrastructure for the AI companies. General Dynamics is another defense company. Okay, so we have a good deal of defense companies in the industrials. And we have some trains and AI benefits companies that help build infrastructure of AI data centers. All right, so let's look at the another one, XLF. This is financial ETF. If we look at these stocks and this one, these are just amazing list of companies that are doing really well this year. Berkshire Hathaway is a stock I'm wondering about right now because the earnings estimates on Berkshire Hathaway aren't that great. If we look at the estimates on Berkshire Hathaway, let's look at, hold on, BR, okay, I hope that's the right symbol. Berkshire Hathaway. If we divide these estimates out going over that, they're only growing like 2 or 3%. This is not very good. And um, I'm thinking right now that Berkshire Hathaway is also losing some of its premium because Warren Buffett was running it. So there's a couple big headways for Berkshire Hathaway. I'm starting to think it's not that great of an investment anymore. But we look at these ones. JP Morgan, all of these are doing awesome this year. Visa, MasterCard, Bank of America, Wells Fargo, Goldman Sachs. And these are all going to be benefiting from deregulation. So that's another reason why the sector might be continuing to do good. Okay, let's look at another chart. Um, this is Altria. They pay like a 6% dividend. They're oversold. And we're getting approaching a time in the stock market where it's volatile. Um, and we're approaching the summertime, which we have two really bad months. So as people are excited right now and greedy and the oscillator is high, this is just the time that you buy a conservative stock that pays a high dividend and it's overbought and it's at the bottom of its range. So that's an example of a stock. Apple, you can see it's in a downtrend. It had some news this week that they're thinking about using AI, and just that one small little news story made it go up like 5% this week or so. But still in a downtrend if you look at these charts. Um, and they're still overvalued. They're like 3 times overvalued. They're only growing at 9%, and their PE is around 30. So um, they could drop 1/3 in value and be fairly valued according to my like strategy and my theories. Okay, so but I'm holding Apple because it's still growing at 9%. They might have to have, it might be a while for them to catch up to that valuation, but um, they're a company that will continue to find a way to make money. Let's look at NVIDIA. NVIDIA has been in a trading range for at least a year. Look at that. In that trading range, we're still kind of at the top of that trading range. Um, and don't be surprised if we fall back into this bottom part of this trading range. We'll watch this breakout. It did break out just a little bit out of this range. Is that a fake out or a breakout? We don't know. But we're coming into some bad times and we have tariff announcements. And one thing that's positive for NVIDIA is there are talks of maybe reducing some of China's reg they limited the chips that they can sell to China. And if they stop that and allow NVIDIA to sell to China all their chips, then that could really make the stock take off. And if that news comes out, this stock's like going up to here next. Um, Otherwise, we might be we're like in a um, news kind of event right now. If it's good news for tariffs and or allowing NVIDIA to sell to China, then its stock goes up. Otherwise, we're going down. All right. So let's look at the stock screen. I looked at some interesting stocks on this list. Fluor, they are a industrial, and look at this. They're like 1/3 off. That's interesting. The problem is they've had some bad earnings reports, so it might take a while for their financials and all of their estimates to be updated correctly. So we'll look at this stock maybe in a week or two. But I've been watching this stock for a while, and it's definitely down, but it might take a while. We'll wait a little bit for their earnings estimates to update. Edison International. This is an example of a utility. It pays like a 7% dividend, and it shows here that its PEG ratio is 0.71. So that's around a 30% discount. And okay, so they're electricity provider. Newmont Corp, they are about 21% undervalued according to this. They basically um, are a miner of gold, and gold is a little bit. It's up 27% this year, and we'll have to look at this not today, but another day. So it seems like they're a little bit undervalued. So we'll look at that next time. We have Goldman Sachs, another stock that's going to benefit from deregulation and IPOs coming out this year. All the financials have run a lot. So we have to wait for them to come back and come in some. So we're going to look at Edison International because our theme this week is, it's going to get nuts in the summertime, and we're going to have some volatility. So we have to be ready for some safe investments. Edison, let me see, their earnings estimates, they don't seem that great. They're up from this year to next year, only up 1%. And the next year after that, they're up 6.6%, and then they're up 6%. So let's say they're growing around 6%. Their dividend is 6.4%. So their total return is 12%, 12.5%. So the PE ratio is really low at 8%, or is at 8. So the PEG ratio is around 0.7 or 30% off. So the headwinds for this company, there's high electricity demand from AI data centers. We have interest rates going down. Investors will reach for high yield as the interest rates go down. And we also have stock market volatility. So as the stock market becomes unstable with tariff announcements next week, people will be rushing towards safe things. Okay, so keep this one in mind. We have the statistics for this company. It's only a $20 billion company. The forward PE is 8, and the PEG ratio, according to Yahoo Finance, is 0.5. That's close to our estimate. The profit margin is really good at 15, and the return on equity is 15. That is really good too. So it's kind of like a decent stock, and it pays a dividend of 7%. So this is one you can hide at, whenever there's volatility. And they have 38 billion in debt. That's that's kind of a lot for a company with a $20 billion market cap. That's like double um, their market cap. But utility companies traditionally spend a lot on new projects. So it's capital intensive. So maybe this industry needs to spend a lot and have a lot of debt in order to do what it has to do. So that is a lot of debt, and that's one reason I wouldn't invest in it because it's has a lot of debt. Oh well, that was good, something to look at. Maybe if during their conference calls they say how they're going to prepay that. Or maybe if I look at other utility companies, then they're all heavily indebted because of their business type. Maybe I'll look back into this as a good investment. All right, let's look at the Edison International, their chart for 5 years. They're basically trading where they were during the pandemic. So something major must have been wrong here. I couldn't find out why they dropped so much. But if you look at their chart, here's the pandemic, and here's where they are right now. So they're right where they were at the pandemic. So there must be something fundamentally wrong with the company for it to be down there again. But they do have a high dividend, um, and it seems like it's pretty reliable industry. So I'd have to look into that debt to see why they owe so much. But if you look at this year's chart, just 1 year, you can see they're in a trading range and they're kind of trading down. They dropped a lot here. I couldn't find a good story why they dropped a lot. Um, so, okay, so that's like we'll wait to see about that company before we buy that one. Um, I did a Google search, Jim Cramer's Club Picks, and one of these stocks that the AI guy told me was COF, and another was DOV. And so these are stocks that Jim Cramer likes. So I thought it'd be interesting to look into those two. Um, all right, so Capital One Financial, they just bought Discover Card. So they have their own network. You wouldn't believe how hard it is to establish a network. We have three major networks for in America right now. We have American Express, Visa, MasterCard, and Discover. And they bought Discover. So one of the four major credit card networks they own right now. And they also brand credit cards for MasterCard and Visa. So it's surprising they allowed um, this company, this bank, to buy Discover Card, but they did. So they're actually direct competitor now to Visa and MasterCard and American Express. So they should deserve a valuation similar to those. So I thought it would be interesting to go over the financials on this one, a Jim Cramer pick. Okay, so we see the estimates for this company. Um, they're growing around 21%, and they have a 1% dividend. So that's around a 22% total return. And what I thought it would be interesting, their forward PE is 14. So if you divide 14 by 21, you get PEG ratio of 0.63, which is they're 37% undervalued. And I thought it'd be interesting to put them side by side with another credit card network of MasterCard. So MasterCard and Visa are famous for having very high um, profitability. So what I'm thinking is it's going to take a while, but COF might be able to have that same profitability and the same valuation. You can see the valuation for MasterCard versus um, Capital One. It's almost half or more, like 2.5 times the PE ratio. And look at the PEG ratio is 1.62, and it's much higher for MasterCard. So let's look at some of the other numbers. We have rats. Okay, we have okay, profit margin for um, MasterCard is 45%. That's a lot. And we have profit margin is only 17% for COF. Return on equity is 8, and return on equity for MasterCard is 187. Okay, so, but let me see. Okay, so actually, Capital One has 5 billion in cash, so they don't have any debt, which is pretty good. So, if we compare MasterCard and Visa, it seems like MasterCard is like almost double the valuation. So, um, I'm thinking COF might have um, some room to come. I mean, it might go up some more because it's undervalued. It ran a lot recently. So if you look at a chart on COF, you can see it ran a lot. But with market volatility, if we get it back down to this range down here, because it's in a zigzag pattern from the beginning of the year, you kind of don't buy it here and you buy it when it gets back down here. So part of investing is keeping track of charts like this and waiting for them to come in to a buy range. So right now we're overbought and we're at the top of the range, and we want to wait for it to come down to here and be oversold. And it might take a month or so before that happens. So that was a good little exercise. And let's see what CFRA said about COF. They said they have a buy rating on it, which is good. They said our 4-star ratings reflect their acquisition of Discover, which we viewed as a long-term growth driver. Networks are difficult to build organically, and Discover enables non-credit risk revenue while offering expense synergies. So they have this integration is going to be really good for the company. And they say their fair value is undervalued by 1.67%. So it's a right around the fair value, a little bit undervalued. So um, that's a good, I always wait for this fair value calculation to really know if I'm getting a good deal or not. You can see their earnings are decent. They're not very predictable. They're not in a straight line, like maybe Facebook or Meta is, but it's okay. Let's look at the Morningstar. They say that it's overvalued by 20%. So we'll keep that in mind. And another stock on Jim Cramer's list, let's say AI told us DOV is on his list. I thought it'd be interesting to look into DOV, Dover. Okay, Dover is kind of, they're in a sideways trading range for the last year or so. At the top of their stochastics, so they're overbought and they're above most of the moving averages right now, which is positive. So I thought it'd be interesting to look at what this company does. They're basically a industrial company. They do manufacturing. Let's look at their growth rates for the next couple of years. It seems like they're growing around 9.4%, 10%, let's say. Their PE ratio is 20. So they're 2 times overvalued if we do our calculations. We divide 9% growth by the PE, which is 20, and we get 2. And that's 2 times overvalued. So, but they benefit from the AI infrastructure build out. So that's the big catalyst I can see. Their profit margin is 29, which is 3 times better than we were looking for. Return on equity is 16, which is kind of near our minimum of what we want. They have around 1 billion in debt, which isn't a whole lot for their market cap of 25 billion. So all that matches up. So they're double overvalued right now. So they better have a good story. Um, so let's look at what CFRA said. They said it's a buy. They said our buy reflects their transformation towards higher margin products, growth markets, while customers may delay capital projects due to tariff uncertainty. Current backlogs provide good visibility. Okay, so that's a bonus, having backlogs. Boeing is another example of a company with like a 10-year backlog. So that helps have confidence in their earnings estimates. Dove margin quality has improved through automation, strategic pricing, and operational efficiency. The strong balance sheet positions it well for M&A, so they might buy some companies. And their fair value is 272, and that's undervalued by 48%. Wow, that is unexpected. Based on our numbers, it seemed like they're overvalued, but they CFRA sees something that we don't. Um, Earnings seem to be going up in a straight line. That's decent, but they're kind of inconsistent. Let's look at the return on equity. That's been very consistent at around 23, which is really good. And let's see what Morningstar says. They said the fair value is 6%. Oh, so they say it's 6% overvalued. So we don't have a consensus that this company is a good company. I'll have to get some more information on this before I would buy it. It looks very inconsistent and um, I don't know why CFRA would want to, they think it's undervalued by 48%. So we'll see about that. Um, and okay. So this is another reminder, every 3 months, the major mutual funds, hedge funds, small, um, well, companies that have large amounts of money being managed, they have to report their top holdings of their funds. And it's a really good idea to keep a list of all of the top stocks in each of these funds. And whenever one of them goes down a lot, um, it's a good idea to start looking at it. The only stock right now that's out of favor in the stock market is Eli Lilly. It's one that's out of favor. So almost every other one is rallying into this market. So as we go down in the summer months, we're going to keep an eye on the updates to these top 10 holdings. And if any of these do drop like 20%, we're going to start looking at them to see if they have any credence. All right. I hope you like that and hope you have a good week ahead. And I'll see you next time.